Welcome to our journey into the heart of financial turmoil. Today, we are about to unfold the story of a catastrophic event that shook the world to its core, the 2008 economic collapse. An event so significant, it has left an indelible mark on our global economy. But why should we care about an event that happened over a decade ago? Because the lessons learned from this financial disaster continue to shape economic policies and practices around the world today. In this video, we will explore the build-up to the crash, the heart-stopping moments of the collapse, and the far-reaching impacts that still echo today. We'll delve into the key actions taken during and after the crisis, debate the effectiveness of those actions, and examine the long-term changes and legacy left in its wake. So, fasten your seatbelts and prepare for a roller coaster ride through the highs and lows of the 2008 economic collapse. As we navigate this complex narrative, we hope to provide you with a deeper understanding of the economic world we live in today. Stay tuned as we set the stage for this financial saga in our next scene. In 2008, our world experienced a seismic shift. An economic collapse unraveled that led to financial upheavals, rewriting the way we understand money and markets. This is From Boom to Doom, the unmasking of the 2008 economic collapse. Today we are about to embark on an exhaustive exploration of one of the most tumultuous periods in recent financial history. In this scrutinizing journey, we'll take a close look at how the reckless lending practices of financial institutions and banks, primarily in the housing sector, set the stage for the economic catastrophe. These institutions, driven by the short-term profit motive, approved loans to subprime borrowers, igniting a ticking time bomb in the global economy. We'll also dissect the role of government policies in this meltdown. The deregulation of financial markets, a strategy that was once intended to stimulate growth, ironically played a critical role in the economic implosion. These policies allowed financial institutions to operate with minimal oversight, leading to risky lending devastating consequences. Moreover, we'll unravel how the bursting of the housing bubble, a consequence of speculative trading and poor risk assessment, acted as the final nail in the economy's coffin. Our thorough understanding of these factors and their interplay will paint a detailed picture of the complex circumstances that led to the 2008 economic collapse. We invite you to join us as we delve deeper into this incredible story, shedding light on the lessons we've learned and the changes we've seen in the aftermath of this financial hurricane. The next 90 seconds promise to be an enlightening reveal of the factors that led us from economic boom to doom. During the period leading up to the crisis, the economic landscape was dominated by a distinctive boom in the housing market. To paint a more detailed picture of this, between 2000 and 2006, home prices rose by more than 85%, an unprecedented surge in the modern era. Fueling this rise were incredibly low interest rates, often hovering near 1% levels, making mortgages more affordable than ever before. Banks and financial institutions began to offer high-risk mortgage lending with fervor. In 2005 alone, subprime loans accounted for over 20% of all mortgage lending. That's a staggering $600 billion worth of high-risk loans in a single year. This boom wasn't limited to a specific region, but was rather a nationwide phenomenon. The sunny state of California, for instance, witnessed a mind-boggling 170% increase in median home prices, while Nevada and Florida weren't far behind, with increases of around 135% and 150% respectively. However, this wasn't a real sustainable growth but rather an inflated bubble waiting to burst. A false sense of security pervaded the market. People were taking out loans they could hardly afford, lured by the tantalizing prospects of an ever-rising property market. Speculative investments ran rampant. The average Joe was now a property investor, flipping houses faster than hot pancakes at a breakfast diner. So in essence, this extraordinary boom in the housing market, propelled by low interest rates and high-risk lending, set up the economy for an inevitable fall. An economic crisis was just waiting to unravel. In 2007, a crucial turning point in history was marked by the bursting of the housing bubble. This event, far from insignificant, was the result of a risky tendency that had become all too common: the issuing of subprime mortgages. Subprime mortgages, or loans granted to individuals with less than stellar credit scores, are typically high risk for lenders. The lenders compensated for this increased risk by charging higher interest rates. This situation reached its peak when these subprime mortgages were bundled into mortgage-backed securities and sold to investors who were often unaware of the true risk they were taking on. When the high-risk borrowers began to default on their loans as interest rates reset higher, it triggered a chain reaction that rippled throughout the entire financial system. This bursting of the housing bubble led to an alarming increase in mortgage defaults and foreclosures. Ordinary homeowners were hit hardest, many finding themselves with homes now worth significantly less than what they owed on their mortgages. This resulted in a flood of properties being dumped onto the market, further driving down home prices and escalating the crisis. As the wave of foreclosures spread, it triggered a domino effect that didn't just affect banks and other financial institutions, but shook the very foundations of the global economy. The liquidity of these institutions was severely impacted, forcing many to close their doors and leading to widespread economic instability. This cataclysmic event served as a stark reminder of the risks of unchecked speculation and the devastating consequences that can follow when the bubble bursts. The crisis invoked immediate and far-reaching effects, spreading shockwaves across the globe. The collapse of major financial institutions was just the tip of the iceberg. The crisis was the catalyst for a cascading series of unfortunate events that led to stock market crashes, causing a ripple effect across world economies. Wall Street was hit hard, with stock prices plummeting and businesses shuttering, creating a domino effect that was felt around the globe. Amid this financial turmoil, governments worldwide had no choice but to intervene. They stepped in with financial aid and policy changes in a concerted effort to revive their ailing economies. But despite these widespread efforts, the ramifications of the crisis were deeply felt at the personal level. Peppered across the globe were countless narratives of personal tragedies. Job losses were rampant, with companies both big and small succumbing to the crisis and laying off employees in droves. Countless individuals found themselves jobless overnight, their dreams of financial security shattered. The housing market was not spared either. Many lost their homes to foreclosures, unable to keep up with mortgage payments as their financial situation took a hit. The dream of home ownership for many turned into a nightmare. The crisis also deferred many people's dreams of starting a business, of going to college, of retiring comfortably. The crisis was more than just numbers on a balance sheet, it was a real, tangible human tragedy. The impacts were felt by everyday individuals, their lives disrupted, dreams deferred, and futures uncertain. The immediate aftermath of the crisis was a grim reminder of our financial system's fragility and the devastating effects when it falters. The decisions and maneuvers orchestrated by the White House and international leaders were instrumental in stabilizing the economy during the crisis. These included a range of measures specifically designed to bolster the economy and stimulate growth, such as significant bailout packages and carefully calculated fiscal stimulus measures. Let's delve a bit deeper into these key actions. The bailout packages, for instance, were multi-billion-dollar schemes, designed to prop up industries that were on the verge of collapse. These were notably aimed at sectors such as banking and automotive, which were severely affected by the crisis. These packages worked by providing these sectors with the much-needed capital to continue their operations and stave off bankruptcy. On the other hand, fiscal stimulus measures were implemented to boost the economy. These primarily focused on increasing the aggregate demand within the economy. Ways through which this was achieved ranged from tax cuts, increased government spending on infrastructure, to direct payments to citizens. These measures, although controversial in some quarters, served to kickstart economic activity and restore consumer confidence. The effectiveness of these efforts, however, remains a topic of heated discussion. The ongoing debates about the implications of these actions, their pros and cons, their long-term impacts, and the potential for future use are indeed worth examining in greater detail. This detailed examination of the actions taken by global leaders and the ensuing debates offers an insightful perspective into the intricacies of economic stabilization measures and their potential to steer the economy during a crisis. The enduring alterations brought forth by the crisis, including comprehensive regulatory reforms, changes in consumer behavior, and significant shifts in economic policy, are all part of the crisis's rich legacy. This legacy, a result of bitter lessons learned, continues to shape our economic landscape. To start with the regulatory reforms, stringent measures have been put in place to monitor and control financial activities. Banks and financial institutions now operate under tighter restrictions, with increased transparency and accountability, reducing the likelihood of fraudulent practices that can lead to major financial crises. Turning to adjustments in consumer behavior, the crisis has instilled a sense of cautiousness. in the spending habits of consumers. More people are saving and investing wisely, giving preference to needs over wants, thus contributing to a more responsible and balanced economy. Now, let's consider the shifts in economic policy. The crisis has led to a rethinking of traditional economic paradigms. Monetary policies have become more proactive rather than reactive, with an increased emphasis on preemptive measures to avoid economic downturns. Fiscal are more geared towards economic stability and growth, even at the cost of short-term gains. It's also important to understand the early warning signs of an economic crisis, as they can provide valuable time to react and mitigate the impacts. An eye for excessive credit growth, housing bubbles, and other such indicators can be crucial in preventing future crises. Furthermore, the role of responsible financial management cannot be overstated. It includes maintaining a balanced budget, prudent decision-making and risk management, and timely addressing of any emerging financial discrepancies. In essence, the legacy of the crisis has been a catalyst for comprehensive changes in financial regulations, consumer behavior, and economic policies, reinforcing the importance of vigilance and responsibility to prevent future crises. The 2008 economic collapse was not just a financial meltdown, but a stark wake-up call for the world. It was a jarring reminder of the impact that unchecked financial practices can have on our. It brought to light the fragility of our economic systems and the need for better foresight, planning, and resilience. It emphasized the importance of learning from our past mistakes to such crises in the future. We are now standing at a critical juncture where we have the opportunity to translate these lessons into actions. We can build a more resilient, inclusive, and robust future for ourselves and the generations to come. To achieve this, we need to stimulate discussions, share insights, and engage in thought-provoking conversations about these pivotal moments in history. I urge you, our viewers, not just to passively consume this content, but actively participate in this discourse. Share your thoughts, your ideas, your lessons learned from the past. Engage in conversations with each other, challenge the status quo, and be a part of the solution. If you find this content valuable, like, share, and subscribe our channel for more insightful perspectives on historical events and their impact on our lives today. We update our content regularly, and you can follow us on our social media channels for real-time updates. By engaging in these conversations, we can foster economic literacy and empowerment and build a world that is better prepared for the challenges of the future. As we have journeyed through the 2008 economic collapse and its aftermath, we've seen the domino effects of unchecked financial practices and the far-reaching impacts of a global financial crisis. We've also noted the importance of foresight, planning, and resilience in safeguarding our futures. But all these lessons and insights would be in vain if we don't put them into practice. And that's where the power of engagement and economic literacy comes in. Understanding the economic forces that shape our world is not just for economists or financial gurus. It's for every one of us. Because these forces don't just impact the stock market or big corporations. They impact our jobs, our savings, our dreams, and our future. So let's take this journey of understanding together. Let's challenge the status quo, stimulate discussions, and share insights. Let's be a part of the solution. As we close this chapter, remember, your voice matters, your ideas matter, your engagement matters. Engage with us in the comments section below, share this video with your friends and loved ones, and let's foster a community of economic literacy and empowerment. Because together we can build a more resilient, inclusive, and robust future. So let's get the conversation started.